Today is Saturday, the 21st of January. And this is not a market recap. This is an earnings recap. We're going to review the earnings that we got this week and what a week it was. Absolute insanity. But folks, these earnings are telling something about the economy. These earnings are serving as leading indicators to what's about to happen in the stock market. Paying attention to the details is what really makes the difference in this game. Now here's the problem. I've been doing YouTube for about 2 years plus, and I've been doing these earnings reviews where I discuss the fundamentals and details. And I actually share names that I'm buying, names that I'm shorting based on these earnings. Now, unfortunately, of course, a lot of the viewers who say, "Hey, Maverick, you're not doing enough. What's with the slacking? You never tell us what to buy. You're perma-bear." And I say, how is calling somebody a bear an insult? Bears are big and powerful, and they can slice your face into a pizza. But anyways, these same viewers don't pay attention to these kind of videos at all. And I bet this video will get half of the views that we usually get. And the reason is the majority of retail traders are not really interested in learning how to invest and trade this market properly. They're just interested in, "Hey Maverick, strike price, expiration date. How about you just download DraftKings and bet on football instead?" But I know at the end of the day, there is a degenerate gambler in all of us. And that's fine. But how about we pay some attention to the fundamentals so we can at least invest properly? Now, what is the importance behind this earnings season in particular? Why is this earnings season so consequential to the economy and the stock market? Well, I got for you at least 3 reasons on why this earnings season is perhaps one of the most important earnings season we have seen in a long, long time. And I'm watching for these things in each earnings report. I'm looking at the details and I'm taking notes. Number 1, I want to see what is the impact of the recent drop of the US dollar on earnings. Because in Q4, the dollar went down. And the question becomes, is the dollar going down helping corporate earnings or not? And if it is it masking bad fundamentals, meaning a reduction in the top line, in the bottom line, and companies are just sliding by because the dollar went down? Number 2, I want to see the impact of the recent consumer weakness on sequential revenue growth. Now, what does that mean, sequential? It means quarter over quarter, because the majority of the focus in these earnings reports is usually laser focused on year-to-year numbers. But when it comes to the recent macroeconomics data, specifically the recent changes and shifts in trends, we have to look at the quarter over quarter. And if we start to see declines in revenue from company after company after company, the seasonality aside, that could be a major warning signal, a major leading indicator that we have trouble ahead. Number 3, as inflation cools, are corporate revenues dropping faster than expenses or vice versa? Why is this important? Now that inflation is cooling, the assumption is the pricing power for corporations also diminishes. And that comes hand in hand with the weakness in the consumer. But so long as the pricing power, aka revenues, are going down at a slower pace than the drop in expenses, because when you see inflation going down, the assumption is corporate expenses should also go down. But if the rate of drop in revenues is slower than the rate of drop in expenses, then so far, so good. Margins will remain intact. But if the rate of decline in revenues exceeds the rate of decline in expenses, then we got a problem. And this problem is the pricing power for corporations is diminishing faster than the rate of growth in their expenses. In other words, inflation when it comes to expenses is stickier, and that will impact margins negatively. So these are the 3 things that I'm watching for, and I want you to take some notes in each report that we go over. Look at these 3 points. What is the impact of the recent drop in the dollar on earnings? Are we seeing the recent weakness in the consumer reflecting in earnings? And number 3, which one is dropping faster? Expenses or revenues? If it is expenses, so far so good. But if it is revenues dropping faster than expenses, we got a problem here. Anyhow, these are the major earnings reports that we got this week. And of course, I have a mistake. Atlassian is actually reporting on February. It did not report this week. Now, we did the review for Goldman Sachs. We made a whole video about it, and Goldman Sachs earnings were a disaster. But we can see the same trends and the same theme in all of these investment banks, even Morgan Stanley. Now, the only reason Morgan Stanley looked good is because people pinned it against Goldman Sachs. And when you compare a trash can with a landfill, the trash can looks a lot cleaner. So we're going to start with United Airlines because there was a lot of talk about, oh, the airliners are doing good. The consumer is shifting from goods to services. And this is the time to go ahead and buy airlines and cruises and hotels because the consumer is still doing pretty good despite all of these reports. And I keep saying, folks, the devil is always in the details. Now, before we look at United Airlines earnings, I have to share with you one of my favorite metrics, which is basically the operating margin. I love the operating margin. And the reason is you take the operating profit of the company, you divide it by net sales and multiply by 100, you get operating margins. Now, what is the importance behind this metric? The answer is it tells us exactly how much is the company keeping in profits from each dollar it generates in sales. And then we can pin this ratio with comparable competitors in the same sector, perhaps, to figure out which stock we should buy. For example, if you want to buy airlines, which company is producing the best operating margins? Which company is keeping the most out of each dollar they generate in sales? Likewise, we can develop a trend with the operating margin quarter over quarter and see whether the operating margin is going down or moving higher. If it is moving higher, then this stock is a buy. But if the trend is negative, then this is a warning sign that you should be getting out of this stock because the fundamentals are getting worse. So keep an eye on that when we discuss the operating margin for each company. Now, here's the report that we got from United Airlines, and we look at the rate of growth in revenues versus the rate of growth in expenses in each quarter. And by the way, I'm teaching you how to do earnings the hood way. If you go to Wharton and Harvard and Goldman Sachs, you'll pay tens of thousands of dollars, and after all of that, you're still going to be confused. The way I teach it, some guys in the hood can look at this and start making money in the stock market. So anyways, when we look at the rate of growth in revenues versus the rate of growth in expenses for United in Q4 2022, revenues were up by almost 14% year on year. And when we talk about year on year for airliners, we have to pin it against 2019 because we all know what happened in 2020, 2021 under the thing lockdowns. So thank you for United Airlines for providing us with the 2019 numbers instead of 2021. So when we pin 2022 to 2019, the rate of growth in revenues 14%. On the other hand, expenses went higher by almost 10%. So the rate of growth in revenues exceeding the rate of growth in expenses for this quarter versus 2019. So far, so good. No problems here. This is actually what you want to see. But there are signs for concern here. For example, the rate of growth in aircraft fuel versus 2019 was up by 47.5%. So United is paying a lot more than they used to pay for aircraft fuel in 2019. Now, what does that say? Just so you understand, when people say that United Airlines earnings were good, the airliners are going to fly high from this point on, we have to distinguish between two important things. Since the end of Q4, what is going on in the trend of expenses for United Airlines? What's going on with aircraft fuel prices right now? The answer is they're going higher. So in the next report, we're going to see United Airlines paying more for aircraft fuel, meaning their expenses will go higher, not lower. On top of that, as you can see, we have a major shortage in pilots. So folks keep saying that we have a surge in demand for traveling, yada, yada, yada. In other words, we're going to have a massive shortage in pilots, if that is the case, which means all of these airliners are going to pay more in compensation in pilot salaries. You have to incentivize these pilots to come out of retirement, for example, or even train new pilots, and that costs a lot of money. In other words, expenses for United will move higher from this point on. What about the rate of revenue growth, on the other hand? Because so long as the rate of revenue growth exceeds the rate of growth in expenses, so far, so good. We're seeing weakness in the consumer according to retail sales data. So we can look at this report, and it is a decent report. Make no mistake at all. But what is the catch here? The catch is United charged an arm and a leg in the fourth quarter for these tickets. And the consumer had no other choice but to pay and buy these tickets. They had to travel. And with the Southwest fiasco, a lot of folks had to pay an arm and a leg to get home using United Airlines. And the question becomes, will this performance be replicated in Q1 in 23, which is, by the way, known as one of the slowest travel seasons? The answer is, when you put two and two together, it doesn't look good down the road. But for now, looking back at the rear view mirror, what do we see here? We see operating margins 11.10%. That's a decent number for airliners. We see the net income, the bottom line, up by 31.5% versus 2019. That is a very decent number. number. But again, we have signs for concern here. Look, for example, at non-operating expenses, which pretty much means expenses related to interest rates. And we know that interest rates are moving higher. United is paying more now versus 2019. So this is yet one corner of concern besides the rise in expenses and perhaps the difficulty of replicating the performance of Q4 when it comes to revenues in Q1 of 23. Now, when we talk about the operating margin, you see it at 11.10%. And we have a trend here. The operating margin for United Airlines since 22 has improved dramatically. This is a good sign for the name, but once again, the stock is going to react based on what it sees in the next quarter. So the question becomes, if you want to buy United or you want to short it, will the operating margins hold as we see expenses being stickier than the growth in revenues? Something really important to keep in mind. Now, when we look at the regions for United Airlines, passenger revenue across the board is positive by double digits. The exception is the Pacific region. That was down by 24.3%, but it's no biggie. It's more than made up for by domestic travel, Europe, Latin America, etc., etc. Now, here's an important metric for you. PRASM, which is passenger revenue per available seat miles. Now, what does that mean? Available seat miles. This is an important metric in the airlines industry. It means if an airplane has 200 seats available for sale, you multiply this by the miles traveled by the airplane and you get the available seat miles. And when you pin it against the revenue, you get the PRSM, passenger revenue per available seat miles. Positive across the board, no problem here. But here's the problem. When we look at available seat miles versus Q4 in 2019, mostly negative across the board. What does that mean? Either the company had less seats to sell, which is most likely not the case, or they flew less, meaning all in all, the company traveled less than 2019. In other words, what does that mean? If the company traveled less, but the revenue is higher than 2019. The finding becomes United Airlines is doing a lot of price gouging here. They're charging a lot more than they charged for the tickets in 2019. And so far, according to this report, the consumer has been receptive. But will the consumer remain receptive in the quarters to come? This is the question that you have to answer before you go ahead and buy United Airlines or any airliner for that matter. Now we're done with the fundamentals. Let's talk about the technicals for UAL. And I did trade the name before earnings, and I said that UAL will report earnings after the bell. My sentiment is the report will be good, and indeed it was good, at least on face value. But the stock might fall either way because it ran too high before the report. If you share the same sentiment, you can play this by buying puts on other airliners, and my pick is AAL, American Airlines. And by the way, I ended up buying puts on both, American and United. What happened after the bell? Both of them shot up higher. A lot of you were like, hey, Maverick, what's going on? We bought puts. We're holding the bag. And I said, the algos alone. We'll sell them tomorrow, if not tonight after the call. And the lesson here is, when you're playing or trading earnings season, when you have a particular stock that ran too high, too fast, ahead of the report, the risk becomes to the downside, even if the report comes out decent, because the algos will do the job. They will dump the stock even though the report was good. Likewise, when a stock drops too fast, big time, ahead of the report, the risk becomes to the upside, even if the report comes out ugly, because that's already priced in. The algos will do the opposite and pump the stock higher. So this is something you got to keep in mind when you're trading options ahead of earnings season. And by the way, another way you can play earnings season in an intelligent way, understand that you have to position yourself ahead of time, meaning if you wait till the last minute, you buy before the earnings report comes out, the premiums are going to be too high. It's not going to be worth it to trade options at that point. But if you're looking at these charts, you're looking at, I don't know, I'm just throwing a name out there. Meta ran too high, too fast. It's going to report in the next few weeks. So this is the time right now to strategize regarding Meta or whatever name that's going to report. You're not going to wait till the last minute to make your moves. And when it comes to UAL, immediately, I said airliners lost all of the gains, and I expect UAL to close the gap at 48 and move below that. And this is exactly what happened. UAL flushed down big reversal candle. It gave you the opportunity to buy puts right away and ride the ride down. It did close the gap. Now we have a reflex. It's going to be really tough for the name to crack above that reversal candle. And most importantly, when we look at the weekly chart for UAL, did anything change here? Absolutely not. The chart remains within a range. And so long it remains within this range, nothing happened. We have to see a decisive crack one way or the other, above or below this consolidation range, before we make a move one way or the other. But again, the fundamentals are more important than the technicals. technicals and they hold more weight. So you have to ask the question, can United Airlines replicate this performance in Q1 and 23, Q2 and beyond? Or will the weakness in the consumer prohibit the company from replicating this performance? If it is the latter, then this is a name you want to avoid being in. Now, here's another important name that reported earnings this week, JB Hunt, a really good indicator for the health of the economy going forward. This is a trucking company. They transport goods. So it is the kind of stock that we look at as a leading indicator. If JB Hunt is not doing good, that would be a bad leading indicator for the economy. So let's look at the numbers here, and immediately we have to look at the growth rate in revenues versus the growth rate in expenses. And I don't understand why companies don't provide us with the ratios. Maybe they're embarrassed, so I'm going to do the job for them. The growth rate in revenues year on year for JB Hunt, 4.36%. On the other hand, the growth rate in expenses, 6%. So immediately we have a problem here. The growth rate in expenses exceeds the growth rate in revenues, a bad leading indicator for the company. Why is this happening? We have to dig more in the categories of expenses. And when we do that, oh boy, when we talk about wages, up 15% year on year. In other words, if this underperformance continues by JB Hunt, look for layoffs coming out of this company. And here's another stunning one. Fuel expenses up by 54.5% year on year. Another stunning one. Insurance and claims up 148% year on year. And this is, by the way, happening across the board. Even your own auto insurance right now is skyrocketing. On top of the insane auto loan payments that you're paying right now, you're also paying an arm and a leg in insurance. You know that, and JB Hunt for sure knows that. Now, when you get such an abysmal report where expenses are surging and skyrocketing year on year, but your revenues are not doing the same, it is no wonder why net earnings are down by 19% year over year. And the operating margin for the company, which means how much does the company keeps in each dollar generated in revenue, the answer is 7.72%. In other words, the company keeps about $8 from each $100 generated in revenues. Is this good? I don't see it as good. I mean, United Airlines is doing a lot better than this. Perhaps the most alarming is look at the operating margin. Look at the trend here, quarter over quarter. In the most recent quarter for JB Hunt, the operating margin is dropping like a rock. This is a company that has a major problem. So now that we know the fundamentals absolutely suck in JB Hunt, what about the technicals? Well, here it is. We have a trend, a positive trend that was broken. And now we have a consolidation phase with an important number as a resistance here, 195.45. Now, if you want to chase this higher, if you want to play this, you got to look at this number, 195.45. If we have a crack above it, most importantly, a weekly closing above it, then you can chase the rally all the way till the next test, which happens to be 209.41, which is the top of a breakdown candle. Now, here's the problem with such formation or such pattern in the charts. We have a major trend that was broken, and then we have a consolidation phase where the chart is collecting feedback from earnings, from the macro data, from the Fed. It continues to consolidate back and forth based on the data, up and down, up and down, up and down. Usually, the chart doesn't give up too fast. It wants to go back and reclaim the trend line. But again, usually that is met with failure. For example, when we zoom out, the same chart, JBHT weekly chart, we also have a trend. The trend is broken. This trend lasted from 2016 all the way till 2019. Once the trend is broken, we got a consolidation phase just like we're seeing right now. And that consolidation phase ended up with failure. It couldn't reclaim the same trend line back again, and it broke down, making a new low. And my hunch is we will see the same this time around too. Next, we have Schwab, but I'm going to skip this because we covered Goldman Sachs. All of these investment banks are not doing pretty good. Stock market is down, and they're taking a lot of risk, at least in the case of Goldman Sachs, and the numbers don't look good at all. So let's talk about Alcoa, another important indicator for the health of the economy, another cyclical name, aluminum, the everything metal. If the demand for aluminum is going down, look, China reopening or no China reopening, that spells doom for the economy. So let's take a look here. And by the way, a reminder, some of you remember this, the older viewers of this channel. I used to be one of the biggest cheerleaders for Alcoa in 2020, 2021. Because the case was we have inflation in aluminum prices. And that alone makes the case for buying the stock. But since then, folks, we sold the name. We sold the name in 21. It made a head and shoulder formation. We got rid of it. And since then, the fundamentals got a lot worse. Unbelievable. For example, when we look at the different categories contributing to the EBITDA for the company, we only have one. Barely one contributing positively to the EBITDA, and that is currency. In other words, we're seeing the recent drop in the US dollar reflecting positively in Alcoa's EBITDA. But besides the currency impact, The price of the metal itself not doing pretty good, contributing negatively by perhaps the most because aluminum prices went down big time. API, that's negative. Raw materials, negative. Production cost, negative. The others category, negative. And the only positive besides currency is energy, not by a lot, and the price mix, but the volume remains the same. In other words, Alcoa did not see a major reduction or major increase in volume. The demand remains pretty much the same for the quarter over quarter, but the problem is the price of aluminum continues to go down. That is impacting Alcoa negatively big time. Now, when you have such dynamic in your earnings and you see EBITDA dropping like a rock, what happens to your cash balance? The answer is it goes down. When you look at the chart, year-end cash balance since 2020, 21, the cash balance was going higher, and so was the stock. But then the stock started to go down because the stock noticed the trend ahead of time that the cash balance of the company will go down since we have the contributors to EBITDA moving down, most importantly, aluminum prices. So the company now has to dig into its own pockets to pay for expenses, and that reduces the cash balance of the company. And the numbers, folks, speak for themselves. Look at this. The growth rate in revenues year on year down by 22.26%. Unbelievable. Now, the growth rate, or the lack thereof, in expenses down by 15.5%. That's good. But again, the rate of decrease in revenues exceeding the rate of decrease in expenses. So yes, maybe Alcoa managed expenses better than last year, but they screwed up the revenues. I mean, it's out of their hand to begin with. Aluminum prices, they go down. There's nothing you can do. And therefore, the bottom line is a net loss down 8.13% year on year. When we look at the operating margin, for example, the trend is going down and down and down. Not the kind of stock you want to be in. On top of that, when we look at free cash flow year on year, this is for the entire year, by the way, down 35.47%. And again, when the majority of the categories contributing to your EBITDA going negative, you're gonna have to use your cash to pay for all of these expenses. And therefore, cash goes down, cash flow also goes negative. Again, not the kind of stock you want to be in until and unless aluminum prices recover. Speaking of, let's go over the technicals since we're done with the fundamentals here. What do we see? We have a trend line. The trend line made a topping formation, the head and shoulder. It broke the trend line. It formed a reverse ABC pattern. And now we're seeing the same thing as in JB Hunt, for example. The trend line is broken. Now we have a consolidation phase. If you want to look at the consolidation phase from a bullish lens, we have the potential of a reverse head and shoulder formation. The problem is you can't really bet on it until two things happen. Number one, a recovery in aluminum prices. Number two, the chart closing above 53, which is an important resistance line on weekly basis. If you got the two check marks, you got my blessing to buy Alcoa and chase the rally higher. And then we have perhaps the most important earnings report for the week. All eyes were on Netflix, but folks, the most important one with huge ramifications and leading indicators for the economy is actually P&G, Procter & Gamble. And the headline reads, Procter & Gamble shares have slipped around 1% today after PG raised its full year sales forecast, listen to this, on the back of price increases to cover transportation, commodity, labor cost, and the impact of the strong US dollar. What is the take here? You and me, the consumer, we're going to pay more and more and more. When they say inflation is dead, they have no idea what they're talking about. Corporate earnings, the numbers say companies like P&G will be forced, keyword, forced, to continue to increase prices higher and higher and higher, even if that comes at the expense of demand reduction, because there is nothing else they can do about it. Their expenses are rising higher. Their revenues dropping faster than their expenses. They say inflation is cooling. Procter & Gamble says yes, inflation is cooling in our revenues, but not in our expenses. And so long as the rate of inflation in expenses continues to be sticky, that will be a major problem for these corporations. Here's the evidence. Let's look at the different categories for P&G and see what's going on here. Look, for example, at the beauty segment. Net sales all in all down by 3%. And this is coming from volume, sales volume down by 4% year on year, meaning folks are not buying more. Folks are actually spending less on beauty products from P&G. When it comes to the foreign exchange, the dollar, it remains too hot for a company that is a big multinational. So that shaved off about 8% of net sales. The mix, that's another 2% gone. What is the reaction to all of this by P&G's management? The answer is they're jacking prices higher and higher by 9%. But even as they do so, that's not enough to produce positive net sales. In other words, P&G will have to continue to raise prices higher and higher and higher. And the question becomes, are you paying attention, Mr. Powell? Are you paying attention, Mrs. Braindead? Are you paying attention, Mr. Bullard and the rest of the zombies? Are you paying attention, Mr. Biden and Brian Deese and the propagandists? Are you paying attention to what's going on here? Prices are not going to go down. I promise you. In real life, prices will continue to go higher. Look at the grooming segment, for example. Net sales down an abysmal 9% year on year. Volume down by 8%. That's bad. The demand is disappearing as we speak right now. The dollar remains too hot for a company this big, and that shaved about 9% out of earnings. The mix, that's another 3%. So they raised prices by 11% year on year. And the only thing they can do right now is continue to jack up prices higher. And oh, by the way, they have to reduce expenses too. You know what that means? Don't be surprised when you read the headline, Procter & Gamble is laying off X number of employees. You're gonna see this headline coming soon. And the reason is, look at this. When we look at net sales down by 1% year on year, on the other hand, the cost of products sold actually up by 2%. The expenses are down by 1%, but again, costs up 2%, sales down 1%. Not a good dynamic. Although the operating margin remains pretty good at 23%, but these consumer staples companies usually have higher profit margins and higher operating margins than other companies. So keep that in mind. Now, all in all, the bottom line down by 7% year on year. Not a good dynamic here. And when we look at the trend for operating margins, yes, it is still holding on. Nothing changing here. Nothing impressive. Up or down. So it all comes down to the management of expenses. In other words, folks, they're gonna lay off employees. And the reason is, when we look at the trend quarter over quarter, the sequential trend for sales growth, cost of goods sales growth, and expenses growth, what do we see here? Now, mind you, you're gonna see numbers going negative and then positive again. That's due to the seasonality. For example, Q4 is usually hotter than Q1, etc., etc. But the assumption is the seasonality should hold the same for sales, for the cost of goods sold, and for expenses. Because if we have divergences in these three categories, that becomes a leading indicator to the dynamic between revenues and expenses that's going on in this company and perhaps the sector all in all, and maybe the wider economy. Look at what happened in Q4, ladies and gentlemen. Expenses shot up higher for Procter & Gamble, big time, while the rate of growth in sales went down. Very alarming dynamic here. And if we continue to see this dynamic, not just from Procter, but from the rest of them, Amazon, Google, Coca-Cola, then folks, we have stagflation in the economy. If that is the case, the valuation of these stocks will plummet dramatically in the stock market because there is nothing else they can do when it comes to the revenue growth besides continuing to jack prices higher as they continue to watch their expenses ballooning. And when raising prices doesn't work anymore, and it is not working anymore in the case of P&G, you gotta resort to reducing expenses. Now, the company has no control over fuel costs or commodities costs or the dollar, but they have control over salaries. They have control over the headcount in the company. And therefore, folks, when I say prepare for the tsunami of layoffs, I'm not joking here. You're seeing the numbers telling the story right in front of you right now. And therefore, when we look at the technicals for PG, what do we see here? This is a weekly chart. Again, we have a trend line. It formed a topping formation of a head and shoulder back in 2020, and it went down in a retest of the trend line. That held pretty good. And then it went higher, forming another topping formation in 2022, 2021. That is the double top. And after that, the trend line was gone once and for all. And that was followed by a bear flag pattern, which broke down. And then we got a reflex from a double bottom. And Procter & Gamble rallied significantly higher since then. But all in all, what are we seeing here? The same theme with JB Hunt and Alcoa. Trend line is broken. Now we have a consolidation phase. Folks get excited that we're going to recapture the trend line once again. The fundamentals are getting better. The Fed is doing whatever. And then what happens? Reality hits and the stock goes down and it makes a lower low. And that is supported, by the way, by the monthly chart in PG. We had a trend of higher highs. And then the chart recently made a lower high. You look at the RSI in negative divergence. You look at the MACD also in negative divergence. And it is accelerating toward negative momentum, indicating that the chart will indeed make a lower low. And then we have Fastenal. It's a company that I like, and I attempted to buy it before. I made a video about it. I said this company is beating inflation. I bought it then, didn't work out. I had to get rid of it, but maybe now is the time to go along Fastenal. And the reason is, look at this. Net sales year on year up by 16.1%. Expenses up by 13%, so the rate of growth in revenues exceeding the rate of growth in expenses. And look at this, beautiful. The operating margin stands at 21%. My man. All in all, the net earnings, the bottom line of the company, up by 17.5% year on year. You're not going to see these kind of positive earnings in a lot of companies right now. And when we look at the chart of FAST, weekly chart, what do we see here? We have a sloping, trending line of resistance that keeps pushing the chart down over and over and over and over again. But recently, the chart made a higher low, forming a reverse head and shoulder formation. Now, to be in the safe side, you might want to wait for the crack above the sloping line of resistance and a weekly closing above that line, and then Fastenal will be a major buy. And of course, the big kahuna for the week was Netflix. All eyes were on Netflix, and the name did respond positively big time on Friday, up by about 9%. So was the report really that good? Well, let's take a look, and here it is. We'll look at revenues Q4 2022. The year-on-year growth 1.9%. That's positive. The problem is, look at the trend here. Last year it was 16%. Last quarter it was 5.9%. The one before that it was 8.7% or 6%, excuse me. So 1.9%. I'm not impressed by that at all. We will look at the operating margin, 7% for the quarter. But this is bad because last quarter it was 19.3%. And mind you, this is a subscription-based company. We should see some level of consistency here in the operating margin. So we're not going to look at year on year. We have to look at quarter over quarter. And when you do that, this is a disaster. Operating margins down big quarter over quarter. And again, down year on year too. The net income down big. Look at this. $55 million. Last year, same quarter, they made $607 million. Last quarter, they made almost $1.4 billion. This is an abysmal number when it comes to the bottom line. Make no mistake about it at all. Year on year, down by 91%. Stunning. Quarter over quarter, down by 96%. Now, when we look at the paid membership growth year on year, 4% for the quarter. But again, last quarter was 4.5%. And year over year, the number was 8.9%. This quarter, it is down to 4%. I'm not seeing anything impressive here at all. But perhaps the market was more forgiving when it came to Netflix earnings. And the reason is, in the last quarter, Netflix reported subscriber growth across the board. Every single region was up. That's number one. Number two, a lot of the miss in revenue came from the currency impact. So the market looks at this and says, okay, they're gaining subscribers. They're not losing anymore. And the dollar is going down. So we shouldn't be too harsh on Netflix here. But I'll show you the numbers and you tell me. When we look at the United States and Canada, revenue down by 0.19% quarter over quarter. And again, we're doing quarter over quarter because this is a company with reoccurring revenue. It's a membership model. So we shouldn't look at year over year. We should look at the sequential growth rate. When we do the same for paid memberships, they gained about 900,000 subscribers. Not bad. At least, unlike other quarters that we've seen before, Netflix is not losing subscribers in US and Canada. And perhaps this is the impact of the new tier, the ad tier. It is literally adding more subscribers. Here's the problem. When we look at the average revenue per membership, it is down about 14 cents in the fourth quarter of 22. And this is, of course, quarter over quarter. When we look at the EMEA region, Middle East, Europe, Africa, revenues down by about $26 million quarter over quarter. Paid memberships, on the other hand, up by about 3.2 million new paid memberships. That's pretty good. The problem is the average revenue per membership down by about 38 cents, but that could be explained by the currency impact because absent of the strong dollar, the year-on-year growth should have been positive by 5%, instead it went negative by 10%. This is only due to the currency impact. My hunch is this is why the market was forgiving to the abysmal report out of Netflix. When we look at Latin America, for example, down by about $700,000 in the quarter, but they gained about 1.7 million new paid subscriptions. The problem is the revenue per membership is down about 28 cents, and again, that could be explained by the currency impact. Absent of the strong dollar, the growth should have been about 7%, but because of the strong dollar, went down to only 2%. Last but not least, in the Asia Pacific, revenues were down by about $32 million, but paid memberships increased by 1.8 million almost. The problem is the average revenue per membership, of course, down again by 65 cents. But once again, that could be explained by the currency impact. Absent of the strong dollar, revenues in the Asia Pacific for Netflix could have been down by only 4%. Instead, they went down by a stunning 17% for the quarter. Now we're done with the fundamentals. What about the technicals, the chart? We look at the weekly chart for NFLX. It is up big time since the recent bottom, up by about 110%. Massive rally. The problem is, when we identify the upcoming resistance, we see massive and major resistance zone. It held us support before, it held us resistance before. It has been a consolidation zone over and over and over again. So the assumption is Netflix rallies all the way till the consolidation zone, and then it runs out of gas. And then it becomes a boring stock. It's up to the company. Do they want to be a dividend kind of stock or share buybacks kind of stock? My preference would be Netflix should be issuing a dividend at that time and paying folks to hold the stock. Another way we can look at it, look at the monthly chart for Netflix. We have a defined range of support and resistance. Support 230. If the stock goes below that, it's a buy. And then we have 386. That is the resistance. If the stock goes above that, it is a sell. Take your profit, go home. Now, a lot of you wanted me to talk about my trade for Netflix pre-earnings. When I looked at the options grid, the implied move was of about 10% one way or the other. But a lot of folks were betting that Netflix is going to crash because it ran too fast, too high, ahead of the number. Here's what I said. Still looking at the direction, the case for buying calls when it comes to Netflix. The Dixie's down for the quarter. We did not see that reflected in earnings, at least not yet. Number 2 earnings targets already lowered, so they're going to beat, at least on the top line. Number 3, a big short position built up ahead of earnings. Always not a good sign. Number 4, Josh Brown just sold it. Josh Brown is the guy from CNBC. I'm just teasing Josh. He bought it almost at the bottom, made a quick profit, big time. It was the disciplined thing to do to take your profits ahead of the major report, because it could have gone the other way easily. The only thing the market was forgiving, because the dollar is going down, it continues to go down, and the market tends to look forward, and it looks forward and it sees, okay, it's not going to be this bad for Netflix in the next quarter. And I also said that the case for buying puts, the underperformance of the new ad tier. Number 2, the cannibalization effect from the new tier. We haven't seen any of that yet. And then number 3, and this is why a lot of folks bet against Netflix ahead of the print. The stock rallied significantly ahead of the print, so the risk versus reward becomes that it's going to go down. And then number 4, global economic weakness, especially in Asia, could have caused a surge in cancellations. Now, we saw the weakest region was Asia Pacific, so I was right on that, but the market decided to ignore that and look past it because it sees the dollar going down. Now, in my last call, I said that I did sell a credit spread, a call credit spread for NFLX with the expiration date of tomorrow, meaning last Friday. So I sold the 330 and I bought the 335. And then I did open another spread for next week's expiration. And this time around, it's a debit spread. And I did that by going long the 330 and shorting the 335, meaning I bought the 330, sold the 335. The reason why I did choose this structure instead of buying naked calls or naked puts, I wasn't sure where it's going to go. I didn't want to invest a lot in the trade. I wanted to get as close as zero entry cost as possible. And the cost was practically nothing. It was 40 cents a piece when using this structure, because you got 2 trades covering for one another. You got one spread that you short. This is with the shorter expiration date. You got the other spread, the exact one, only this time around you're long. So they cancel each other out. And the goal from playing it this way is to reduce the entry cost as much as possible and reduce risk as much as possible. The problem with the trade is you gotta get the strikes right. And in this case, I got my strikes a little too low. I should have gone higher, and then the trade would have worked out perfectly. So the lesson here is maybe you want to use this structure exactly for upcoming earnings that you're not sure about. It could go either way. So you're opening 2 spreads, credit spread, debit spread, all covered under a calendar spread structure. Doing so eliminates the risk as much as possible, meaning you're not going to lose anything at all. You're only going to lose your entry cost if the trade goes the other way, meaning the 40 cents. That's not a big investment at all, but you got to get the strikes right. You got to get the timing right for the trade to be profitable. And here's the illustration for you. When we look at Netflix, this is the 4 hours chart. The credit spreads expired January 20. The debit spreads expires by the end of the month. And the goal is for Netflix to pop higher after the print, but not close above 330 by the end of the week. That way you end up capturing the entire credit from the spread expiring immediately. And then Netflix moves higher all the way north of 330, but your profit stops at 335 because you sold that one short. In other words, you get the $5, the $6 from the credit spread, and then you get another $5 from the debit spread. Now, your investment of 40 cents got you at least $10 in profit. That is a massive, massive profit. Had it worked, of course. In my case, it did not work out. Although I did walk with profit, be it a small one. And the reason is Netflix popped significantly higher, above 330. It was north of 340. For the entirety of the day, for the most part at least. So immediately after the open, when I saw Netflix at 340 and north of 340, I did close the debit spread for next week's expiration. And I got myself north of $5 a piece in profit. And then as the name started to pull back, and it got to 335, 333, I believe, and then bounced higher again to 335, telling me that more likely than not, Netflix is going to close above 330 by a lot. So I did close the credit spread, and that gave me a little bit of profit, which is basically the time value because I had to pay $5 a piece to close the credit spread. And then I collected about $6.40 a piece from closing the debit spread for next week. So all in all, I did walk out with profit. The problem is it wasn't as I intended. So the lesson of the day is, had I did the 345, 350 instead, I would have walked out with an insane profit. So again, when you're trading options before these earnings, you gotta plan ahead. But if you didn't plan ahead, you wanna throw your hat in the ring the last minute, you probably wanna do it this way to reduce the risk as much as possible. And last but not least, in corporate earnings this week, how about my favorite name, SLB, Schlumberger, doesn't matter to me. They call it SOB, not SOB, SLB. You don't want to call it SOB, you're going to piss me off. But look at this. You're not going to find these kind of numbers all over the place. Revenues up by 27% year on year. Expenses up by 21% year on year. Operating margin, 20%. That's not bad at all. Net income up 75% year on year. When we look at the different categories for the name, the revenues year on year, up double digits across all categories. We have one sign of concern in digital and integration when it comes to operating margins because that went down by about 2 basis points year on year. That's not a big deal at all. This is a decent report, as decent as you can get at this stage right now. Those are the fundamentals, of course. Now, what about the technicals? The name ran a little high, too fast ahead of the print. So, of course, we got a negative reaction, not by a lot. It was just a little negative reaction after the print was out. Now, here's the thing. We could see SLB moving down from this point on, actually closing some gaps below 54.79, but it will rebound higher. The aggregate demand will kick in. Managers who've been waiting to buy this name, now they got the confirmation. So any pullback in this name will be an opportunity to buy. I promise you, they're going to buy it. The managers across the board, they're talking about it. Those who have it, they're going to add more. Those who've been waiting on the sidelines, they will hop in and buy it. Because this is a report that justifies for those waiting on the sidelines that yes, you should be in this name, not out waiting for a better opportunity. You might not get it. It might pull back by a little bit, goes to 54, 53, and then rebounds higher again. So watch out for a pullback here, and then a rebound higher again. With that, folks, this is a recap for week number 1 in earnings season. What a week it was. But at least now you have some trends, you have some things to look for in next week's earnings. We're going to start to get the heavyweights coming out. We have, I believe, Tesla, Microsoft coming out. And of course, we're going to do the reviews for all of these names. With that being said, this is all I got for you for now. Thank you for listening. Thank you for watching. And if you happen to be a member of this channel, I'm going to talk to you again tomorrow. Take care and have a great weekend.